Good morning, I'm Benjamin Sullivan, and welcome to Market Monday for July 13th, 2026. Last week brought record highs, a tech stumble, airstrikes in the Middle East, and the biggest Wall Street debut by a foreign company in history. Let's dig in. We'll start with technology, as that's where the drama was. On Tuesday, the chip makers that power artificial intelligence dropped around 4.5% in a single day on a familiar worry. Are companies spending too much on AI, and will those investments pay off? AI spending has been the driving force of this bull market, with the four largest tech companies plan to spend roughly $750 billion just this year in building data centers. By Friday, the market gave its answer. SK Hynix, a South Korean company that makes computer memory chips, the components that store data for AI systems, raised $26.5 billion after launching its NASDAQ listing. That's the largest US debut by a foreign company ever. And investors asked for about 7 times the offered shares. Micron, its Boise-based competitor, announced $250 billion in new US factories the same week. Investors sent a message. While there's plenty of skepticism in the headlines, our money will still flow to AI. Our second story is another familiar topic, the Middle East. The ceasefire between the US and Iran broke down last week, with strikes on both sides over the Strait of Hormuz. Oil prices jumped midweek, with foreign crude prices topping $76 a barrel, before easing as diplomats worked to restart talks. Stocks didn't stumble even as those headlines hit. Market participants are operating under the assumption that this is a pattern of flare-ups, not a full-blown supply crisis. But it's worth watching. So far, investors are treating it as noise, not a change in trend. Last week, we got a highly anticipated jobs report. The economy added just 57,000 jobs in June, roughly half of what economists expected. Stocks rallied on that news, with the Dow Jones Industrial Average closing above 53,000 for the first time ever on Monday. You might be asking yourself, why would weak hiring be good news? Because the Federal Reserve under Chair Kevin Warsh is focused on fighting the sticky inflation, which is still above 3%, and has been debating whether to raise rates, not cut them. A cooler job market takes some of the pressure off, reducing the odds of rate hikes. Markets now expect the Fed to hold steady at its meeting later this month. The current dynamic sounds unintuitive. Poor economic data makes stocks go up. However, a softer economy usually leads to rate cuts, reducing the cost of borrowing. In a market driven by AI investment, access to cheap capital is imperative. Last week also marked the start of earnings season. PepsiCo disappointed investors and Delta Airlines beat expectations, but the stock fell on higher fuel costs, a direct result of the oil story. One more item before we look ahead, and this one may apply to your family. Trump accounts went live on the 4th of July. The government will seed $1,000 into an index fund for every baby born since the start of 2025. And millions of children have already been enrolled. So, if there's a new baby in your family, whether you're the parent, the grandparent, or congratulations, the great-grandparent, reach out. We'll get you on the calendar. I had a kid last year myself. I'm going through this right now. Now for the week ahead. Circle Tuesday, July 14th on your calendar, because it's a busy day. We'll get the June inflation report, Fed Chair Warsh will testify before Congress, and the nation's biggest banks will report earnings. JP Morgan, Bank of America, Goldman Sachs, Wells Fargo, and Citigroup. Wednesday brings wholesale inflation data, and Thursday we'll get earnings from Netflix and chip giant Taiwan Semiconductor. If inflation comes in hot, the rate hike conversation comes right back. If it's tame, the market gets more room to run. That's all we have for you today. As always, thank you for watching this week's edition of Market Monday. Join us again next Monday for more of the insights that matter to your money.